Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two of the upcoming big tech earnings reports from Apple and Amazon to see if it's worth buying either of these big tech giants for upcoming possible breakouts and some long-term upside. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into Apple and Amazon ahead of their earnings releases to see if it's worth buying those stocks, I quickly just want to break down a little bit of the broader market to help make a case for why maybe you should be getting into stocks in general at the moment, and especially these two tech names. So the bulls stopped the bleeding at the start of the last full week of April. They held the line at the S&P 500 and the NASDAQ's 21-week moving averages. And the question then on everyone's mind is kind of what would happen next. The bears brushed off a lot of that foam on top, and the bulls are trying now to quickly fight back above that 50-day moving average. So as I'm recording this on Friday afternoon, we have the NASDAQ up about 2.2% and the S&P 500 up 1.2%, driven by big gains from Alphabet and Microsoft, who both reported after the bell on Thursday. So Alphabet had that big jump today because it followed Meta's lead from earlier in the year, and it declared its first ever dividend, highlighting big tech's new commitment to profits and returning value to shareholders, while also touting its new and continued AI investments. And Microsoft also had another strong quarter. And this came after Tesla had a bounce earlier after its release. And that was a lot of to do with that. At a certain point, it seemed like any positivity from Tesla would help the stock after it had been crushed so far this year. And now we'll kind of see then what happens with Apple and Amazon, who are sort of the next two major names to report their quarterly results as the market wades through all of these big tech earnings reports and decides if it's going to be time to kind of chop around or send the major indexes, as I said, back above that 50-day moving average and possibly head up towards new highs in the coming weeks. As I said, though, overall, the bulls stopped that bleeding at that 21-week moving average, which is a positive sign. So the near term, we could either see more chop, or we could possibly see if these big tech earnings results, especially from Apple and Amazon now coming up next, if they're able to wow Wall Street and send the market up towards above that 50-day moving average and then head higher and higher from there. So the first of these two big tech names we're going to dive into is Apple, which trades in ticker, as most people know, AAPL. Its shares, unlike a lot of these big tech names going into its report, outside of Tesla, are down almost 15% from their December records. And the question is, should investors consider buying that iPhone powerhouse heading into actually its Q2 FY 2024 results, a little bit of a different calendar schedule for Apple, which are due out on Thursday, May 2nd. So let's start with some of the recent worries, which are the reasons why Apple stock is down 15%, even as the market soared to new highs and a lot of its big tech peers have soared higher and higher despite that recent pullback. So Wall Street's pretty worried about its slowing growth in China. Apple's new iPhone sales in China fell 24% year over year in the first 6 weeks of 2024, according to research firm Counterpoint, as the U.S. company faced increased competition from domestic rivals. The U.S. tech giant's chief competitor in China in premium smartphones, which is Huawei, saw its unit sales climb 64% in that period, according to the same report. And then more recently, an updated report on April 15th noted that Apple's iPhone shipments dropped almost 10% in the first quarter of the year, as the tech giant found its market share dominance under pressure once again from various rivals. Apple, as I said, facing that mounting competition, and there's various geopolitical things at work here between the U.S. and China that are playing into this role, which is part of the reason why a lot of people are nervous about this longer term growth in China. And then on April 19th, we saw another Apple and China news story, which was that the Chinese government told Apple to remove some of the most popular chat messaging apps from its app store in the country. It's kind of the latest example of censorship demands on the company from the Chinese government. So we saw that the company that China asked Apple to remove WhatsApp and Threads from its app store. And Apple said it was told to remove certain apps because of national security concerns. The company said in a statement, "We are obligated to follow the laws in the countries where we operate, even if we disagree." So these are kind of the broader worries about slowing growth in China, which is its second largest market. So that's part of the reason why the stock is down 15%. Investors are also worried that Apple is possibly falling behind on the artificial intelligence front, and they might have been a little bit uneasy or unnerved by reports earlier in the year that they scrapped their plans to roll out an electric vehicle. And then also earlier this year, so back in March, the Department of Justice filed an antitrust lawsuit against Apple, saying that the iPhone powerhouse has a monopoly over the smartphone market in the U.S. that hurts developers, rivals, and consumers. They say that Apple does all it can to kind of lock users in its operating system. They said that Apple has maintained its power not because of its superiority, but because of its unlawful exclusionary behaviors. Obviously, Apple disputes the government's case, and it denies it has monopoly or violated any law. Apple is going to fight the case to the death, and plus, U.S. officials have also filed anti-monopoly lawsuits against pretty much all of the other big tech companies, Amazon, Google, Meta, in the recent past. So Apple's kind of just another one of these companies that's going to have to kind of dig its heels in and fight back against the government looking into some of its practices. So these are kind of the bear cases for Apple at the moment, which is why the stock is down 15% as the wider market and the tech sector has driven higher to start 2024, despite, as I said, that recent pullback. So overall, its sales declined 2.8%, so about 3.8%, or excuse me, about 3% in 2023. It's 2023, which was its third year-over-year decline in the last 8 years. So Apple is still a somewhat cyclical business based on its iPhone releases. So it's not shocking for the company to have a year-over-year decline like say Meta or Amazon, something like that. And then despite mounting concerns, Apple's business in China and the still only slipped 2% in fiscal 2023. So that's just the perspective on what it did last year. Most recently in Q1 of 2024, its total revenue climbed by 2%, with earnings up 16%. In total, iPhone sales were up 6%, with services revenue up 11%. That said, though, in Greater China, its revenue did fall 13% year over year, which was its only regional sales decline. So this is, once again, that kind of the big China issue hanging over Apple and the stock. So beyond the iPhone, the company obviously is still, as we said, it's still an iPhone giant, but they're getting into generative AI as much as they can. They're doing these efforts, and the ability to back out of the EV area, I think, actually is going to be a really beneficial thing in the long run. It was never going to be a market that they were going to be able to dominate quickly. It takes a lot of investment, and I think going into their own area of tech, core competency is much better than trying to roll out an EV. So overall, Apple sold about $200 billion worth of iPhones in 2023, up from $142 billion in 2019. So that just shows kind of the scale that Apple's working on. And its long-term growth case is not really that difficult in a world full of smartphone addicts and device addicts, as its subscription unit especially gains traction. So its CEO, Tim Cook, has really focused on transforming Apple beyond just that core iPhone business to make money off of its loyal and growing customer base. Its services unit climbed at 9% in 2023 to account for about 22% of sales. So that's just the most recent broader year, just to give perspective. And its efforts include its App Store, obviously, then services that compete against Netflix and Spotify. They also have Apple Wallet, a video game platform, digital workout classes, tons of other things. The company's now surpassed 2.2 billion in active devices. And they have over 1 billion paid subscriptions across its platform. So that's kind of that growth that they're hoping for, continuing on into the future. That is that consistent growth where, as we said, the iPhone can be a little bit swings and misses and cycles that leads to these year-over-year declines in sales. And that is actually double the number that it had just 4 years ago. So it's now 1 billion paid subscriptions. And then another area that is still kind of in the new side of the business that Wall Street and consumers are really not sure how to react to yet are those Vision Pro headsets. The company's been really focused on how to get those headsets into the enterprise world and not necessarily consumers. Consumers have not really fallen head over heels for those yet, but they see it as a way to help bigger businesses innovate in their world, in this new kind of tech everything world where they can help employees in various sectors of the market, from say Walmart all the way to maybe like a big industrial company with using that tech. And then on top of that, they're bringing much more of their chip making in-house, quietly also spending on AI features to add into their smartphone and other devices. And then overall, their cash position, which now some people on Wall Street are a little worried that they possibly have too much cash. They had $65 billion in net cash at the end of last quarter. Of S&P 500 companies with the highest operating cash flow in the last 12 months, Apple was at the top of the list at $116 billion. And that's it's a great thing, also a drawback. At the moment, Wall Street Journal had an article not too long ago that was talking about how some people are just worried that that's a lot of capital to put to work, and doing so very effectively can sometimes be a challenge over times. But I'd say it's better to invest in a company that has a lot of cash to work with and can get into new businesses and buy up into new areas is much better than, say, a company that doesn't have that luxury. So looking ahead to Apple's expected growth in the current quarter, we're calling for a roughly 1%, so 0.67% decline on adjusted earnings, and then a 5% year-over-year decline in sales, with roughly flat sales expected this year and 7% growth on the bottom line this year. And then next year, we're calling for about 5% growth on the top line and about 9% growth on the bottom line. So growth both on this year and next year on the bottom line, with roughly flat sales this year and then 5% growth next year is what we're calling for. And this is not crazy in Apple's business. As I said, this isn't a company that had been doing consistent 10% growth, say like Microsoft or other companies. And then in terms of its earnings revisions, revisions have held pretty steady over the last couple months heading into its release, and its most accurate estimate for its upcoming quarter, so its Q2 of 2024, is up slightly from its consensus, so that's a positive sign. And Apple has beat over the last 4 quarters. Currently, it lands a Zacks ranked number 3 hold. And as I said, now getting kind of into the stock price movement, it's trading 15% below its highs. In fact, it's up just 1% in the last year. And this is compared to the Zacks tech sector, which is up 37%. Despite that pullback, though, the stock's still up 233% in the past 5 years, which easily doubles the Zacks tech sector. And it's up roughly 27% in the past 3 years versus tech's 16% climb. So if you scale that chart back, Apple looks to be in a much better position at the moment, which could actually set up longer-term investors, which we're going to get into at the moment. So it's currently trading below its 200-day and 50-day moving averages, and it experienced that so-called death cross in early March, where the 50-day moving average fell below the 200-day moving average. That obviously, though, that's more for like near-term traders to focus on. It recently retook its 21-day moving average, and it's currently trading in between its 50-week and 200-week. And then this is the longer-term chart that actually could be a more bullish sign for longer-term investors who don't need to worry about exact market timing here for Apple. But it's currently seemingly finding some support at its 21-month moving average. And it's currently sitting at some of its most historically oversold RSI levels over the last 20 years. So if you're a longer term investor, it's certainly worth considering, just kind of based on those facts alone, for this titan of tech that's suffering setbacks. And it's also trading 20% below its average Zacks price target. And then valuation wise, it's trading at a roughly 26% discount to its 10-year highs at 24.8 times forward 12-month earnings, which is also a small discount to tech, despite its longer-term outperformance of that sector. And Wall Street's still relatively high in the stock, though it's not maybe as bullish as it has been in the past. Of the 28 brokerage recommendations that we have, 16 are coming at strong buys with only one sell rating in there. Overall, Apple returned about $27 billion to shareholders last quarter via buybacks and dividends. The firm's investing heavily in its future, from AI to kind of new areas that we can't even imagine at the moment. We have to, sometimes we forget why Apple is where it is. It invented sort of a whole new business that people didn't know, and now iPhone is kind of just something that people take for granted. But you never know when the next thing is going to be around the corner. Obviously, AI is what everyone's focused on now, and they're investing in that. But maybe there's another consumer-focused area that they're going to be able to get into. And with all that cash, they certainly could. So if you're a longer-term investor, obviously it's not flashy to say buy Apple at a 15% discount, and this isn't some under-the-radar stock. But if you're trying to get some big tech exposure when lots of other big tech stocks are trading at brand new all-time highs and have soared heavily over the last year plus, Apple certainly looks to be at a relatively weak point at the moment, so worth considering heading into that earnings report. And now we're going to take a look at the other big tech stock, and that is Amazon. AMZN is the ticker, and they report their first quarter 2024 results on Tuesday, April 30th. So Amazon stock has climbed over 60% in the last 12 months, and they're up about 115% off their lows. However, it has pulled back recently from its all-time highs, which were just above its previous records too. So if it is able to impress, say, like Alphabet or Microsoft, they could possibly break out kind of to a new trading range, which would be positive for investors, both in the short term and the long run. So let's kind of jump into some of their just what's going on with the stock. So slowing growth and higher rates was the big reason for that huge sell-off in 2022 that hurt not just Amazon, but a lot of the tech sector. Thankfully, though, those dynamics have kind of changed, and those rising rates caused Amazon under CEO Andy Jassy to really focus on profits and maximum efficiency after a decade plus of kind of just growth at all costs, and we don't care about the bottom line. Their company's now in a good mix, sort of like Microsoft, where it's focused on the bottom line while also really focused on long-term consistent growth. Amazon still runs the world's largest cloud computing business, and cloud computing is kind of a key pillar of the modern economy, and it's only going to grow in importance. The combination of that steady cloud computing growth and its concentrated efforts on boosting earnings now and kind of forever has breathed fresh life into the stock, and that's kind of the big reason for that huge jump off its lows. Amazon reportedly held roughly 32% of the cloud computing market last quarter versus Microsoft at about 22% and Google at about 11%. It's also attempting to improve its margins in that business by rolling out more in-house chips. It's also, like every big tech company, actively rolling out more AI-focused efforts to attract customers to spend more as everyone kind of races to not get left behind. Their CEO, in a recent letter to its investors, said that, quote, generative AI may be the largest tech transformation since the cloud, which itself is still in the early stages, and perhaps since the internet. Jassy wrote, as I said in that letter, this Gen AI revolution will be built from the start on top of the cloud. The amount of societal and business benefit from the solutions will be possible, will astound us. So they're going to benefit from their own AI efforts, and then the fact that they run a massive cloud computing business, which is just that data center expansion that is going to fuel the AI growth. So Amazon also then obviously has their own e-commerce business, which is the forward-facing world that a lot of people know Amazon for. They're benefiting from streamlining that business, focused on streamlining the fulfillment network instead of kind of regional networks. They currently hold roughly 40% of the total e-commerce market share, blowing away second place Walmart at under 10%. They're also heavily growing their digital advertising segment. The segment climbed 27% in the fourth quarter, marking by far its largest year-over-year percentage gain. So its digital advertising business is massive and a huge growth engine going forward that sometimes gets kind of left off to the side when you're talking about reasons to buy Amazon. Then they're also boosting their Prime segment by rolling out more live streaming entertainment efforts in that streaming world, especially in the sports segment, which is kind of the last thing people need to watch live, where everything else can be streaming. You don't need to see ads. If you're watching a sporting event, ads go along with it because you want to be watching it in the moment. So that kind of goes right into their ad business, which could be another key long-term growth driver for Amazon. So last year, the company did roughly 12% sales growth. And yeah, that's 2023 after 9% growth in 2022, which did mark a significant slowdown from the growth it had been doing before. But the stock already got recalibrated for that. And now that they're focused on the bottom line, Wall Street's more willing to accept slowing growth when you're also growing the bottom line really heavily. So looking ahead, we're calling for roughly 12% growth in 2024 and 2025 on the top line to go from about $575 billion in 2023 all the way up to $716 billion next year. And then on the bottom line is where it gets really impressive too. We're calling for 42% adjusted earnings growth in 2024 and then another 31% growth next year. So just massive bottom line growth on top of what was a big growth year for the company in 2023. And its earnings estimate revisions have trended heavily in the right direction over the last year and more recently since its last earnings report. And its most accurate, which are those most recent Zacks estimates, are coming in well above consensus for Q1, so the quarter they're about to report, as well as 2024 and 2025. So that helps it land a Zacks ranked number 2 buy at the moment. And now in terms of kind of performance, technical levels, and valuation, the stock's sitting at some possibly enticing levels. It climbed, as I said, 115% off its lows. It hit new all-time highs in early April. It's fallen from those levels, and it kind of found resistance at its old records from periods in 2021. So it reached all the way back up, got to brand new highs, but it wasn't able to break out like a lot of these other big tech names. So if it is able to impress, as I sort of alluded to earlier, when it reports, it could easily break out to new levels and then kind of break into a new trading range, which would be a good sign. So overall, the stock's up 1,000% in the last 10 years. First Tech's 280%. This also tops Microsoft, which is up about 930% and almost doubles Alphabet. So that puts Amazon in perspective there. And its recent pullback has taken it from heavily overbought RSI levels to below neutral. The stock's currently trying to find buyers at its 50-day moving average. So that's kind of a near-term line to look at. And then on the longer-term trend line, it's still trading solidly above its longer-term level. So the 21-month, 50-month moving averages, things like that. So plenty of upside there long-term. The stock's down about 5% from its recent records, and it's trading 20% below its average Zacks price target. And then on the valuation front, it's trading at an over 90% discount to its highs and 50% below its 10-year median at 38.5 times forward 12-month earnings. That's still a little pricey maybe for some investors, but investors are willing to pay up for Amazon. The broader tech sector is trading at 25.4 times forward 12-month earnings. There's also a sign that Amazon's forward earnings multiple is going to keep coming down when we consider that its PEG ratio, which factors in its longer-term earnings growth outlook, marks a 22% discount to tech at 1.4. That's a positive sign. And it's now sitting at its lowest levels over the last 10 years in that ratio. So it's a powerhouse in multiple key growth areas of the economy. It's investing in AI. It's certainly worth considering. Amazon, if you want to play it right around earnings, always difficult. As I said, it could possibly break out like we saw Alphabet and Microsoft do, which would be great for near-term investors. But if you're a longer-term investor, the bull case has been laid out. So if you want to get into it with maybe some possible near-term volatility, certainly worth considering that as well. So both Amazon and Apple certainly worth considering, both near-term and long-term, heading into their upcoming earnings releases. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.